Hello and welcome to the Tax Roundup for December. And inside this month we're looking at a new draft ruling on deductions for labour costs in developing capital assets. We're also going to take a look at a really interesting case dealing with deductions denied by the ATO. Now this case really shows how far the ATO will go in some circumstances to validate the deductions being claimed, and in this case it deals with the logbook. But first up, Michael Carruthers is going to take you through the timing of deductions for contributions made through a clearinghouse. Across to you, Michael.
Now, an issue that comes up quite a lot towards the end of an income year is timing issues around making employer super contributions. Now, there's two aspects to this. First of all, it's ensuring that an employer meets their SG obligations by making contributions by the required quarterly deadline. But there's also a timing issue around claiming deductions. Generally, as an employer, you can only claim a deduction if you make the super contribution in that income year. So from a tax planning point of view, what some employers choose to do is make employer super contributions for the June quarter by 30 June, even though they don't need to until early July. And that helps to bring forward a deduction. But in order for that amount to be deductible, the super fund needs to have received the contribution. Now, where this becomes a bit of an issue and where it becomes more complicated is when the employer is using a clearinghouse for making those contributions. Because what you actually need to do is not look at when the contribution is made to the clearinghouse, but look at when the funds have passed from the clearinghouse into the hands of the super fund. And our experience is that that can take some time in some instances. It could take a week or two, for example. Now, from an SG point of view, the legislation deals with this quite specifically, but only when contributions are made using the ATO's small business super clearinghouse. Basically what the rules say is that you've met your SG obligation once you've made the contribution to the ATO's small business clearinghouse, even if it then takes some time for that to pass from the clearinghouse into the hands of the super fund. But you don't get that concession when you're using any other clearinghouse. It has to be the ATO's small business super clearinghouse to take advantage of that particular concession. Now that's something that's enshrined in the legislation. What's not in the legislation is how that applies from a deduction point of view, because the deduction rules simply still look at when the super fund has received the contribution. Now, what the ATO has done is basically extend that position from an administrative point of view when it comes to claiming deductions. The ATO has issued a draft practical compliance guideline, which basically gives us a safe harbour approach. The ATO says they're not going to go looking and they're not going to devote compliance resources to looking at exactly when the funds went from the ATO small business clearinghouse into the employee's super fund. So as long as the employer has made the payment to the ATO small business clearinghouse on or before 30 June, certainly we're looking at last business day before 30 June, and that payment is not dishonoured or rejected, then the employer can basically assume that the deduction can be claimed in that year, even if the funds passed to the super fund in, say, early July. So we've got the legislation dealing with this from an SG point of view. We've got this draft PCG dealing with it from a deduction point of view. But I just want to reiterate once again, this approach for both an SG perspective and a deduction perspective is only available when using the ATO's small business super clearinghouse. It is not available when using other clearinghouses. In those instances, you need to make sure you're factoring in some time, because it could take some time for those payments to find their way into the super fund.
For those professionals that need to complete the FASIA exam and haven't done so as yet, and you want to shortcut your study and make sure your knowledge is spot on coming into the exam, then Knowledge Shop's exam prep training is now online. You can find more details on our website. Now across to the new draft ruling looking at deductions for labour costs in developing capital assets.
Now, the ATO has released a draft ruling which expands on and builds on a principle and a point that was made by the ATO many years ago in an old ATO ID. And it's basically looking at this issue of while labour costs, so salary, wages, payments to contractors, often we'll think of as being deductible expenses where those people are working in the employer's business activities. But the ATO is making the point that that's not necessarily the case, and we still need to consider whether those expenses could be capital in nature. So in order to claim a deduction for an expense under Section 8.1, the general deduction provisions, we need to show that there's a sufficient connection between the expense and the production of assessable income, business activities to produce income. But we also need to check that those expenses are not private or capital in nature. And it's the capital in nature bit that this draft ruling really focuses on. Now, as I said, salary and wage costs, recurring expense of the business, kind of normal business expense, a lot of people typically think those things are deductible. They relate to the business, to producing income. But we do need to look at what it is that the employees or contractors are actually working on. Because if they're working on a project that is capital in nature, well, the costs associated with employing them or paying them would probably be capital in nature too, and would therefore not be deductible immediately. They might be dealt with under some other provision, maybe the depreciation rules, capital works rules, etc. So for example, if staff are hired and they are specifically engaged to construct or install, say, a capital asset, piece of equipment, build a building, those sorts of things, well, it's likely that their labour costs are going to be capital in nature and not immediately deductible. In some cases, you'll have employees or contractors who are involved in a range of things. Some projects which are capital in nature, some which are not capital in nature. There's an expectation from the ATO that a reasonable apportionment is applied to their labour costs. There'll be some people who work on a capital project for a while, but then maybe they're more involved in maintenance and ongoing running of the business or the facility. So it probably switches from capital to revenue nature at some point. Again, there's an expectation that we identify when that happens and treat the costs accordingly. The other thing that the ATO picks up on in this draft ruling is that some people will have some involvement in a capital project, but it's fairly remote. And if that's the case, we don't have to worry about capitalising those costs. So an example that the ATO gives in the draft ruling is of, say, a general manager. The general manager is responsible for all the day-to-day activities of the business, overseeing what happens. And that might include some capital projects that are being undertaken by the business. But where that is more an oversight role and they're not hired or engaged specifically in relation to that project, the ATO says you probably won't need to apportion and capitalise some of their costs. But where someone is engaged specifically in relation to a capital project, well, there is an expectation that that will be treated as capital in nature. So it is an area that we probably just need to be a little bit careful about, particularly where clients are involved in, say, developing intangible assets, copyright, in-house software, those sorts of things, as well as tangible assets like buildings and plant and equipment, and really be careful about how we deal with the labour costs and identifying those costs that might need to be capitalised.
And finally, that case all about their deductions denied by the ATO, where the deduction expenses were validated by a logbook.
Now, we know that the ATO has been really cracking down and focusing on work-related deductions recently. And there's a case that's gone through the tribunal recently which looks at this area and shows how careful taxpayers and advisors need to be when assisting with car expenses and other work-related expenses. Now, in the Reid case, basically what happened here is that the taxpayer was claiming pretty significant deductions relating to their car expenses for their work. And we're talking over $20,000 a year in car expenses. And they were claiming those expenses using the logbook method. Now, the ATO had a bit of an issue with this. When the ATO reviewed the situation, their view was that the logbook kept by the taxpayer was not a valid logbook. It didn't meet the requirements under the logbook rules. As a result, the ATO reduced the deduction down to the maximum amount that would be available under the cents per kilometre approach, which was a deduction of a bit over $3,000. So we've got a taxpayer here missing out on around $17,000 odd worth of deductions in a single year because of the car expenses and because of a supposedly invalid logbook. Now, this went to the AAT, and the AAT confirmed the ATO had taken the right approach here. The AAT said that that logbook was not a valid logbook. And I'll give you some examples of some of the problems from that logbook. For example, some of the entries, the day of the week didn't match the date. So the taxpayer said, I did this travel on Wednesday, but the date they said wasn't a Wednesday. So that was the first problem. In some instances, the odometer readings were repeated multiple times, which clearly is impossible. So that was another flaw in the logbook. Another example is that the taxpayer said on a certain date they were travelling to visit clients or undertaking other business-related travel. Well, the ATO actually went to the step of checking with the employer. And the employer's records indicated that on that day, the taxpayer was on sick leave. So again, clearly there's some inconsistency between the records in the logbook and other evidence surrounding this. Because of these inconsistencies, errors, the AAT was convinced that this was not a valid logbook, therefore the taxpayer could not rely on the logbook and didn't have the required evidence to be able to use the logbook method to reduce the personal use percentage for their travel. As a result, fallback position is using the cents per kilometre method and a much lower deduction. Now, we're not going to look at this in detail, but the case also looked at a range of other expenses claimed by the taxpayer. Home office expenses, phone, internet expenses, a whole range of things that were looked at quite carefully by both the ATO and the tribunal, and where the taxpayer missed out on more deductions because of lack of documentation, poor record keeping, and inconsistencies between what they were saying and what their employer and colleagues were saying in terms of expenses that have been incurred in their situation. So really important, again, wake-up call. We know the ATO is looking at this area carefully. This shows that little mistakes can lead to very significant differences in tax treatment. Certainly as advisors, we can assist clients in this area. If they've actually spent the money on legitimate things, that's fine, but they need to have the records. They need to meet the strict substantiation and documentation rules to be able to claim the deduction. So we can certainly help clients in terms of what records do need to be kept, what will be sufficient to enable that deduction to be claimed, and also try and explain, well, what's the impact if you don't happen to have kept the right records, the sort of tax impact that can have on someone. So really good example, I guess, in some respects of where things can go wrong and how they can go wrong, but also showing how some of these things can possibly be fixed or overcome just by undertaking a review of key deduction areas and key rules around substantiation.
And that's the tax roundup for this month and also for this year. We'd like to wish everybody in the profession a very merry and safe Christmas, and we'll look forward to seeing you next year.